MP3 Live, coming to you on Monday morning, July 30th. I've spent over 30 years studying trends and as a result have developed tools such as the 3-day chart and the 3-week chart methods that define prevailing trends. My job as a trader is not to understand the macro and predict the economy. The market is one thing, the economy is another. A company is one thing, its stock is quite another. This was clearly demonstrated by Friday's behavior, which saw stocks tumble on the best GDP in nearly 4 years. So let's take a look at leadership, the NDX, through the lens of the 3-week and the 3-day chart. The NDX's leadership, for example, it bottomed on the week of November 17th, 2008 versus March 2009 for the S&P 500. Leadership is often the first to bottom and the last to top. Last week, the NDX left an outside down week signal reversal bar from an all-time high, and you can see this. It just nearly missed being an being a key reversal week by closing below the prior week's low. Nevertheless, it was a large range outside down signal reversal bar. I created a close only trend line from the January top. And the early June top. Last week, the NDX broke out above the close only trend line, but reversed with authority to leave this outside down reversal week. Consequently, a false breakout may be on the table. This is important technically because fast, sharp moves often follow false breakouts. So not only did the NDX carve out this large range outside down week last week, but it did so from important resistance, as you can see by this trend line. The week of June 18th also left an outside down week right here from a record high. The next week made a lower weekly low right here. So you have two lower weekly lows, putting the index in my weekly +1, -2 buy position. It responded with a rally. Simply put, this weekly +1, -2 buy position is created when the 3-week chart is pointing up, which happens when you have 3 consecutive higher weekly highs, and then some point further on, as long as the 3-week chart is still pointing up, you get 2 consecutive lower weekly lows, and that's what you got here. And as I said, the market responded right here with a rally. Now, the week of November 27th, let's go back here, right here, also saw the NDX put in an outside down week from a record high. Okay, this is a record high, and you have an outside down week. Not all outside down weeks are created equal. The next week, the NDX made a nominally lower weekly low right here, once again satisfying my weekly +1, -2 buy setup. Again, the index responded with a rally. In fact, that was the low from which a 7-week blowout played out into the January top. That top elicited the largest correction since the February 2016 low. We'll go back and show that in a moment. While this low did not come in precisely, well, here's what I wanted to point out. Once again, right off this January top, and the largest correction since the February 2016 low, once again the NDX went into the +1, -2 buy position. 3-week chart is pointing up. You have 2 consecutive lower weekly lows. Now, while this low did not come in precisely as the NDX went into this position, in other words, The second lower weekly low occurred right here, and the NDX skidded lower. So that's why you want to give it a chance to play out and often look for the close of the week. Just as on all other multiple time frame analysis, you want to look at the close, whether it's the close of the 10-minute bar, wait for the 10 minutes to end, the hour, wait for the hourly close, wait for the daily close. The point is that there was unfinished business here, because despite this angle of attack to the downside, the 3-week chart never turned down with 3 consecutive lower weekly lows. It never did put in a third weekly low until the week of April 2nd. Right here, you can see 3 consecutive lower weekly lows. Ultimately, the NDX responded with a rally from 3 consecutive weekly lows on a test of the February low right here. So you had a double bottom, and finally the 3-week chart turned down was satisfied in early April. So importantly, the April turn down of the 3-week chart was also a test of the early February low. The turn down of the 3-week chart, in league with this test of the February low, backstopped a rally based on this swing chart method I created. As it happens, the 3-week chart turn down on the week of April 2nd, right here, was the first time the 3-week chart turned down since the week of August 21st, 2017. And that's right here. You can see 3 consecutive lower daily lows, and it tied to a test of this red moving average, which is the 20-week moving average. Now, a trend line connecting the 2016 low, the pre-election low, comes in right here. I connect the trend line with the October pre-election closing low to the April closing low for the year, and this ties to about 7,000. As you can see on this chart, this is an important level for several reasons. It ties to the last short-term weekly swing lows right in here. Okay. And it ties to the last turn up of the 3-week chart. The last time the 3-week chart turned up is right. Let's take a look here. We turned down, and the 3-week chart turned up right here. So the 7,000 level ties to the last turn up. That's support. So there's a trifecta of support near this 7,000 level. The NDX was rejected from intermediate resistance last week at this 7,500 level. This ties to big picture primary resistance as I depicted in a report last week. The lower window of that primary resistance stretches all the way, however, from 7,500 to potentially as high as 8,000. If a rally to as high as 8,000 NDX is going to play out, my cycle work suggests this is August business. So it should be easy to tell if yet another outside reversal is on the table and we've just seen another shakeout and buy the dip opportunity, or whether we get downside follow through as August starts. But right now we have 2 factors which will tell us if a trend change is on the table and how important that trend change may be. These 2 factors are the behavior on a possible decline to the 3-point trend line near 7,000. This is the 3-point trend line right here to 7,000. A violation of the last 3-week chart low from April at 63.22 will elicit a time turn trend sell signal on the weeklies. In other words, now that we've turned down the 3-week chart in April and rallied to a new high, a subsequent violation of this circled 3-week chart low is elects a time turn trend signal and implies that a bear market has started. Interestingly, this 6,300 level here ties roughly to the 50-week moving average, this blue line here. The takeaway is that there's a possible waterfall scenario on the table. A break of 7,000, well, first a break of 7,200 and this parallel trend channel implies a test of this trend line, all important trend line, at 7,000. Break below 7,000 will trigger a rule of 4 sell signal. That is simply a break of a 3-point trend line. Typically, after 3-point trend lines on whatever time frame are broken, you see accelerated momentum, and that accelerated momentum should challenge the 50-week MA and ultimately the 3-week chart low at 63.22. So how do we know? How do we get an early warning that this could happen? Well, a turn down of the 3-week chart over the next in August, over the next few weeks, that does not install a low soon in terms of both time and price. This would be a change in complexion from the early April turn down and the late August turn down in 2017 right here. So the weekly swing chart turned down last week because it was rejected from legitimate resistance in the way of this trend line here. The implication is that we have, even in the bullish scheme of things, the likelihood of a 2 to 3 week decline. So if that's true and we get a break here, that should perpetuate at least 3 weeks of decline. Consequently, if the 3-week chart in fact turns down with 3 consecutive lower lows here, and it does not define a low soon in terms of both time and price, a yellow warning flag goes up. Let's drill down to the daily NDX to see what we can see. In this chart, I created a daily close-only trend line connecting the January peak and the March peak, which defines last Wednesday's all-time high. Let me drill back here. Okay, so here you see the January high, the March high, and this comes in right here at about 7,500. And you can see we hit this last week. The NDX reacted with authority when it hit this trend line. In fact, Tuesday, the NDX left a Gilligan sell signal. Let's spread this out. Okay, so here you can see this trend line a little better now. I created a close-only trend line from the January high coming through the March closing high, and the NDX hit this perfectly last Wednesday and was rejected with authority. And as I said, on Tuesday, the NDX actually left a Gilligan sell signal. A Gilligan is a gap to a new 60-day high with the close at near session lows. So here on Tuesday, we gapped up to a new all-time high and closed at near session lows. Wednesday offset Tuesday's sell signal, which should have been a bullish event. In other words, Wednesday, right after the sell signal, you didn't even pull back one day for a second lower, for a first lower low. It offset Tuesday's reversal bar and tagged this trend line. That should have been a bullish event, as it was a reversal of a reversal. Instead, Thursday gapped down. That's this little bar here. We gapped down and sat, tracing out a very narrow range day. It was an NR7 day, the narrowest range in 7 days, and typically these contractions in volatility are met with expansions in volatility within the next few days. And then that's what happened. Friday, the boom was lowered. This 3-day whiplash between Tuesday, Wednesday, and Thursday's price action caught bulls and bears alike to be stopped out and caught blindsided. Many good shorts and some long positions we had were stopped out. And often this is exactly how the perversely talented Mr. Market likes it prior to a trend change. There is a series of head fakes before the train leaves the station. The most important thing to consider about the short-term trend here is the action of the 3-day chart. The 3-day chart turns down, like the 3-week chart, anytime an item makes 3 consecutive lower daily lows. The 3-day chart turned down on Friday, July 20th, right here. It gave rise to a rally. On Friday, July 27th, the 3-day chart turned back down because the NDX violated the 3-day chart low. In other words, you didn't need 3 consecutive lower lows. Once this circled low here was violated, then immediately on the knife down, then immediately the 3-day chart is pointing back down again because it's violated a prior circled 3-day chart low. The prior instances of turn downs on the 3-day chart, were June 25th. This defined a bottoming phase. The prior time was June 19th, which elicited a 1-day rally. So here you see the June 25th turn down, 1, 2, 3, and you didn't go any lower really. It stutter stepped here, eventually putting in a low. And the time prior to that, the instance prior to that, was June 19th, right here, which elicited a 1-day rally. So it is the behavior of the turn downs, not the turn downs in and of themselves, but the behaviors, the subsequent price action when the 3-day and the 3-week chart turn down and turn up, which tell you the nature of the trend and the position of the market. Rapid flipping of the 3-day chart and the 3-week chart often implies a change in trend. Obviously, rapid flipping of the 3-day chart has played out, and that implies a change in trend of the secondary trend because it's the dailies. Rapid flipping of the 3-week chart implies a change in trend of the primary trend because it is the weekly swing chart. Downside momentum on Friday's turn down of the 3-day chart looks like a warning that the NDX has eyes for 7,200, the bottom of this trend channel. 7,200 defines trendline support from May, and importantly, you can see that we have potentially 5 culminating waves up. Here's 1, 2, 3, 4, 5, and it ties to 3 drives to this high. So this 5-wave count ties to a test of an important trend line. The 50-day moving average hasn't been broken since April. Below 7,200 will trigger a rule of 4 sell signal on the dailies. So you can see this 3-point trend line, and a break of 7,200 will trigger a rule of 4 sell signal coincident with this blue line, the 50-day moving average. As I said, that hasn't been broken since April. There is reason to believe the NDX will break 7,200. Why? Well, as I said, notice that you have a 5-wave pattern that's been traced out since the April low. The presumption is, if the near-term trend line at 7,200 is broken with authority, the NDX will be magnetized to support near 6,800, defined by a larger 3-point trend line. That's right here. This is 68 to 6,900 right in here. This support, like this 3-point trend line, this 3-point trend line ties to, you can see it's at 6,800 right here. This trend line ties to the magenta line, the 200-day moving average. So the takeaway is this: the earlier weekly NDX shows the significance of 7,000 support. A waterfall decline could be in the wheelhouse on a break of 7,200 daily support, which then sees a break of 7,000 weekly support. That perpetuates a decline to the 50-week moving average at 6,600. This is the dailies. The weekly support is at 6,600. Now, a break of 6,600 could in turn lead to the time turn trend sell signal we mentioned previously on trade below the last 3-week chart low at 63.22. Actually, it is at 63.22 spot 60. Trade by even one tick below that level elects a time turn trend sell signal, and that could imply the beginning of a bear market. While waterfall declines are rare birds, it's important to notice that the NDX has held its 200-day moving average 3 times so far, 1, 2, 3, in 2018. However, the 200-day has now moved up and is now at 60. Right now it's at around 66.30ish. In other words, the 200-day is roughly coincident with the last 3-week chart low from April at 63.22, below which our time turn trend sell signal would be triggered. So the implication is that this time turn trend signal may be triggered on a test of the lows of the year. I'm sorry, I misspoke. The implication is that if this time turn trend signal is triggered, a test of the lows of the year, the February low, may play out. So a break of this trend line may lead to a break of this trend line and the 200-day moving average, which should see a test of the lows of the year. Now, often following a time turn trend signal, a knee-jerk reaction occurs. Consequently, if we do get downside follow-through here and a test toward the lows of the year, that could perpetuate a knee-jerk rally. If that rally installs a lower high from the all-time highs, a turn down then from that point would put the bears in the driver's seat. So we're going to continue to do updates on the position of the market as the 3-week chart and the 3-day chart dictate, and we'll bring them to you in this space. And it's going to be important to see what happens. It looks like we should get follow through from last week's reversal, And if this trend line at 7,200 breaks, the market will be in a vulnerable position. That's it for now. Good luck trading today.